Hi students, how are you? Can you hear me? Okay, welcome to the class. Okay, students, in the last class we were doing investment appraisal. And in investment appraisal we discussed the accounting rate of return and simple payback. Now we will discuss the investment appraisal techniques in which time value for money is incorporated. So before I discuss the techniques, we will discuss the time value for concept of time value for money, how to determine the time value for money. We will discuss that concept, and we will move on to the next investment appraisal method. So first of all, time value for money. Concept of time value for money. The concept of the time value for money is very simple, that with every passing day, the purchasing power of currency will reduce. Now, for example, today is 2022, and if I tell you that after 8 years in 2030, I will give you $100,000 in 2030. Obviously, the value of this $100,000 today at 2022 would not be equal to $100,000, and the value of this $100,000 on 2022 is known as a present value, and present value will always be less than the future value. Now this $100,000 is a future value. So first of all, we have to determine that in terms of 2020, we have to determine in terms of 2022, what is the value of this $100,000 which I will give you in 2030. That is known as a present value concept or time value for money. Now, how we will determine the time value for money? We have number of methods. How to determine time value for money? TVM, time value for money. We have number of methods. We have method which is known as simple discount factor. In simple discount factor, the present value is equal to future value multiplied by 1 plus R raised to power minus N. Here the R is the rate of return and the N is the number of period. R is the rate of return and N is the number of period. And we use the discount factor to calculate the time value for money in two conditions. Number one, each cash flow is different from the other one. And number two, time period is limited. Now, for example, let's assume we have the following years: year 0, year 1, year 2, year 3, and year 4. Remember the year, when we say the year 0 means today. Year 0 means today. And year 1, year 2, year 3, and year 4 are the future years. Now, for example, if we have the following cash flows, in this scenario, for example, in year 1, I have $100,000 outflow, then I have 500 inflow, then 600, then 400, and then 700. And the rate of return is given, that is equal to 10%. This rate of return is also known as discount factor, or rate of return to be used as a discount factor. Now you can see in this example, you can see that each cash flow from year 0 to year 4, each cash flow is different from the others. These are different cash flows from each other, and they are for limited time period. We know the limit of time here, and that is 4 years. So in this scenario, how we will determine the present value? We will multiply the future cash flows, and these net cash flows are the future cash flow with this discount factor. Now take your calculators. If you determine the discount factor for year 0, if we determine the discount factor for year 0, 1 plus 10% raised to power minus 0, it will be 1. And let me tell you one thing, that you will be given with the table of discount factor will be given. So you can also see that discount factor table in your book or in your exam kit, or you can calculate. So if you simply do 1 plus 10% raised to power minus 0, so in year 0, the discount factor will always be equal to 1. For year 1, 1 plus 10% raised to power minus 1, you will get 0.909. For year 2, 1 plus 10% raised to power minus 2, and you will get 0.826, and so on for the third year. So please do the third year. 1 plus 10% raised to power minus 3, 1 plus 10% raised to power minus 3, you will get 0.751. And for year 4, 0.683. So we have the discount factors. Now, if we multiply the future cash flows with the discount factor for year 0, it will be $1,000. And for year 1, 500 into 0.909, it will be 455. $496. And for third year, this is 300. And for the fourth year, it will be 478. So we have the discount factors. Now, if we total the values, the present values will be equal to, first one is negative and the other one are positive. What will be the net value? $729 positive. So this is the present value, and this is a method where we use the simple discount factor to determine the present value. And the condition where we will use the simple discount factor is that each cash flow is different and time period is limited. You get it? Students, you get the concept? Yes, in a long question, obviously we will take the whole number. We will round it, okay? Yes, you people, you people will have the discount factor table of discount factor and the annuity factor. The both tables will be given in the exam. The other method to determine the time value for money is annuity. Now, in annuity, we have three scenarios. One is known as simple annuity, The second one is known as deferred annuity. And the third one is advance annuity. Now, where the annuity can be used, to use the annuity, we have two conditions. Number one, cash flows are same. The cash flows will be same. And the time period is limited. Now in exam, the simple annuity factor table will be given. But if we have a deferred annuity or advanced annuity, obviously then we have to calculate the deferred and advanced annuity. But the simple annuity will be given in a table, in an exam, in a table format. But even if we don't have the table, in simple annuity and deferred annuity, we can use the following formula to determine the present value, and that is equal to we will take the cash flow and multiply it with the annuity factor, which is 1 minus 1 plus r raised to power minus n divided by r and multiply by discount factor n minus 1. Now, here the n is the numbers of same cash flows and represent the number of same cash flows are represent the rate of return, and n represent the year from where the annuity started. So discount factor n minus 1 is basically discount factor of the year from where the annuity started minus 1. Now, for example, if annuity started from year 2, then 2 minus 1, the discount factor of year 1. If the annuity is starting from year 3, so 3 minus 1, discount factor of year 2. And the annuity means the similar cash flow, the time period from where the similar cash flows are started. Now, for example, let's assume we have the following data: year 1, 2, 3, and 4. Let's assume year 1, 2, 3, and 4. And let's assume we have the following cash flows. We have the following cash flows. And let's assume the rate is 10%. Now you can see here in this example, the condition one is that the cash flow should be similar, and we have similar cash flow from year 1, year 2, year 3, and year 4. The second condition was the time period should be limited, so we have a limited time period, year 1, 2, 3, and 4. This is a limited time period. It is not undeterminable time period. We know the in a coming 4 years, in a coming 4 period, we have a similar cash flow. So what we can do here, we can use the annuity factor. We can use the annuity factor, and this is a simple annuity scenario. This is a simple annuity scenario. So in this case, when I will calculate the present value, I will take a cash flow, which is a similar cash flow, which is 1000, and we will multiply it with 1 minus 1 plus 10% raised to power minus 4 divided by 10% multiply by discount factor n minus 1. Now focus on this factor, discount factor n minus 1. Now in this scenario, from where the annuity is starting, can anyone describe from where the annuity is started? From year 1, from year 1. So discount factor n minus 1. So that means we will multiply it with the discount factor of n from where the annuity started minus 1. So it will be 0. Discount factor of year 0. So this will be the discount factor of year 0. Discount factor of the previous year from the annuity is being started. And here the annuity started from year 1. So 1 minus 1, that means we will multiply it with the discount factor of 0. That will eventually will be equal to 1. So the present value will be equal to into 3.17 multiplied by 1. So 3170 will be the present value. 3170 will be the present value. Another example which will elaborate the concept more clearly. Now let's assume we have the following years. Year 1, 2, 3, 4, and 5. And we have the following cash flows: 100, 120, and then 90, 90, and 90. And again, the rate of return is equal to 10%. Rate of return is equal to 10%. Now, in this case, we have these cash flow which are similar for in year 3, 4, and 5. and these two cash flows are different. So here we will use the concept of deferred annuity factor. Now look how we will solve it. Year 1, 2 and 3 to 5. 100, 120 and 90. And the rate of return is 10%. So in year 1, we will use the discount factor. In year 1 and 2, we will use the discount factor. Discount factor of year 1 is 0.909 and year 2 is 0.826. Simple. 1 plus 10% raised to power minus 1 and 1 plus 10% raised to power minus 2. But from year 3 to year 5, we have the similar cash flows. So here we will use the annuity factor. Here we will use the annuity factor. And the annuity factor will be equal to 1 minus 1 plus 10% raised to power. How many number of cash flows we have same? How many same cash flows we have? In this example, yes, we have 3 similar cash flows. So minus 3 divided by 10%. Multiply by discount factor and minus 1. Now in this scenario, from which period the annuity is started? From which year the annuity is started? Annuity means the from which year the same cash flows are begun. Yes, it is year 3. Yes, year 3. Year 3. Yes. This is year 3, not year 2. It is year 3. So the annuity started from year 3. Now, if the annuity started from year 3 and this is the formula discount factor n minus 1. So n minus 1, discount factor of which year we will use? If the annuity started from year 3, so it will be 3 minus 1. Yes, it will be year 2. So this will be multiplied by 0.826. So what is the annuity factor? One minus one plus 10% raised to power minus 3 divided by 10%, it will be 2.49. 2.49 into 0.826. 2.054. So we will multiply it with 2.0. Yes, 2.054, 2.056. You are absolutely right. So this will be 90, this will be 91. I rounded, this will be 91. 120 into 0.826. And 90 into 2.054. 185. So the present value, total present value will be 91 plus 99, 190. 375. So you can now compare the both examples. Here the annuity started from year 1. Yes, I will. In this example, the annuity started from year 1. So it was the discount factor of year 0. In this example, the annuity started from year 3. So we multiply the annuity factor with the discount factor of the second year. Now, this is the complete formula of the annuity factor. This formula will be given in an exam sheet. The similar formula will be given. In this formula, discount factor n minus 1 mean, basically discount factor n minus 1 means that it is a discount factor of the immediate previous year. This is the discount factor of immediate previous year from the annuity is started. N minus 1, discount factor of immediate previous year from where the annuity is started. Now, for example, if the annuity is started from year 1, this will represent the discount factor of year 0. Now, if the annuity started from year 3, it will represent the discount factor of year 2. Now, if the annuity started from year 2, this will represent the discount factor of year 1. So, discount factor of immediate previous year from the annuity is started. This factor of the discount factor n minus 1 represent basically that thing. So that it is a discount factor of previous year from where the annuity is started. You get it now? Now, why we do this? What is the reason? The reason is when we calculate in this example, when I will use calculate the present value in this data, and if I use only this factor, if I use only this factor, which is in a red circle, it will give me a present value at year 2. This will give me a present value at year 2. and I need a present value at year 0. So we will multiply it again by 0.826. So we get at the present value of year 0. That is the logic. Okay, now I give you an example. You people solve this example and let me know. Now, for example, if you have the following data, and the rate of return is 8%. Calculate the present value. Calculate the present value. Solve this and let me know. Okay, okay. Let's check it. So the rate is 8%. So what is the discount factor of year one? 1 plus 8% raised to power minus 1. What is the discount factor? 0.92. Okay. And now the annuity factor. One minus 1 plus 8%. And we have total number of cash flow 1, 2, 3, and 4. So raised to power minus 4 divided by 8%. Now in this example, from where the annuity is started? From which year? The annuity is started. Can you identify? Yes, students, from where the annuity is started? From which year? Yes, it is from year 2. Now in this example, it is started from year 2. And the discount factor of year 1 is 0.92. So if we solve it, it will be 3.04. Am I right? You get it? Now in this scenario, the annuity was started from year 2. So we multiply it with the discount factor of year 1. So the present value it will be 304 and it will be 83. So total present value is 387. We will get it. Yes, students, you get this? Any question? Okay. So let's test this concept. For example, Mr. A needs $1,500,000 in 5 years to invest in a business. Mr. A wants to know that how much he set or how much he invest an equal amount at the rate of 8% from year one. So he would have $1,500,000 in 5 years. So this is the future value. Let me give you some hints. This is the future value. He wants to know the equal amount which he should invest from year one, then in year two, then three, then four, then five. So he can accumulate $1,500,000 in 5 years' time at the rate of 8%. And let me tell you, we know that the present value is equal to, in an annuity, the present value is equal to the cash flow multiply by 1 minus 1 plus r raised to power minus n divided by r into discount factor n minus 1. I give you the hint also. So please try and German and tell me that how much fund he should invest on annual basis to accumulate $1,500,000 in 5 years' time. You have 5 minutes. Okay, have you determined the answer? Look at here. He needs $1,500,000 in 5 years. So first of all, determine the present value. And if we determine the present value, that will be equal to $1,500,000 into 1 plus 8% raised to power minus 5. So what will be the present value? 1.08 raised to power minus 5 into $1,500,000. The present value will be 1,020,875. That is the present value. Now the next question was how much equal annual amount they should invest. So now if I know the present value, I need to determine the cash flow. And I know that annuity factor will be 1 minus 1 plus 8% raised to power minus 5 divided by 8%. And the funds will be invested from year 1. So if the annuity is going to start from year 1, then the previous year from where the annuity is started will be year 0. If the annuity is going to start from year 1, A is the amount, then the previous year is year 0. And we know that the discount factor of year 0 will be 1. Am I right? You get it? So 1,020,875 will be equal to A, and the annuity factor will be 3.99. It will be 3.99. So the A will be equal to the annual amount will be equal to present value 1,020,875 divided by 3.99. So what is the annual amount? $2,55,858 is the annual amount which should be invested on annual basis, and he will accumulate $1,500,000 in 5 years time at the rate of 8%. You get it? Everyone? Okay, now we will discuss the next concept of annuity, which is advance annuity. That is advance annuity. But before that, remember a rule for time value for money. And the rule is that start of the year or period will be considered as a or as an end of previous year. Now, for example, if I tell you that I will pay you $100,000 from the start of year 1 for next 5 years. If this statement is written, if I take the years, year 1, year 2, year 3, year 4, and year 5, and I'm saying I will pay you $1,000 in year 1, $1,000 in year 2, $1,000 in year 3, $1,000 in year 4, and $1,000 in year 5. This is the time series. But when I will calculate the time value for money, I will follow this rule that the start of the year will be considered at the end of the previous year. So when I have to determine the time value for money, for the time value for money purposes, year 1 will be the year 0. Year 2 will be considered as the end of the year 1. Start of the year 3 will be considered as the end of the year 2. Start of the year 4 will be considered as the end of the year 3. And start of the year 5 will be considered as the end of the year 4. So the start of the year will be considered as the end of the year when we will calculate the time value for money. You get it? So 1,000, 1,000, 1,000, 1,000. Total number of cash flows are 5, but the start of the year was considered as the end of the previous year. So here, this is a scenario which you are looking at is basically advance annuity. This is a basically advance annuity. Similar cash flows for the limited time period, but starting from year 0. Now here we have an annuity which is being started from year 0. The advanced annuity factor formula will be 1 plus 1 minus 1 plus r raised to power minus n minus 1 divided by r. And again here the n is the total number of same cash flows. Total n is the total number of same cash flows. Now for example, in this example, rate of return is 10%. Let's assume the rate of return is 10%. So here the annuity factor will be equal to 1 plus 1 minus 1 plus 10% raised to power minus n minus 1. So how many number of same cash flows? We have total 1, 2, 3, 4 and 5. The number of cash flows we have 5. So 5 minus 1 divided by 10%. So annuity factor will be equal to 1 plus 1 minus 1 plus 10% raised to power minus 4 divided by 10%. So this will give us a total annuity factor of 1 plus 3.17. So the advanced annuity factor will be 4.17. Okay. So the present value will be 1000 into 4.17. So 4170 will be the present value. You get it? Everyone? Okay. Now the third method to determine the present value is perpetuity. Perpetuity is applied in two scenarios. Number one, the cash flows are same, but no limit of time. but we are unable to determine that how many years the cash flow will arise. We are unable to determine that thing. If that is the case, we will use the perpetuity. For example, company will pay dividends of dollar per annum for foreseeable future. So company will pay the dividend, but for foreseeable future. That means we are talking about perpetuity. We are talking about a perpetuity where we don't know that how many dividends will be paid, but we know that on annual basis the dividend will be paid. But how many times it will be paid, we are unable to determine that thing. So in this case, we use the perpetuity to determine the present value, and the formula of the perpetuity is, if we talk about it, without growth, without growth, the formula of perpetuity factor, or you can say the present value, will be equal to cash flow into 1 divided by R into discount factor n minus 1. Similar. And the discount factor of the year from where the perpetuity started. Okay, this is a similar concept of the annuity factor. And if we talk about with growth, in that case, the present value will be equal to cash flow into 1 plus G, 1 plus growth, divided by R minus growth into discount factor n minus 1 into discount factor n minus 1. For example, Ali will receive $1,000 per annum for foreseeable per annum for, you will write it, Ali will receive $1,000 per annum for his entire life, and after the death this right will be transferred to his child. From year one. And the rate is 10%. So Ali is going to receive $1,000 per annum, and he will get it for his entire life. After the death, this right will be transferred to his child, and he will start to receive this $1,000 from the year one. So we know the starting time, but we do not know the end time. So here we will use the perpetuity. So here we are going to use perpetuity to determine the present value, So it is going to start from year one, but how many years we don't know. So we'll use the perpetuity factor, and the present value will be equal to $1,000 into 1 divided by 10%, and this is started from year one. So the previous year is year zero. So discount factor n minus 1 will be the year zero. So it will be the 1. So the present value will be equal to $10,000. You get it? Another example. Ali will receive $1,000 per annum, but from year 3. Other facts are same. He will get it for his entire life, and then it will be transferred to his family. But this time they will start to receive from year 3. The rate of return is again similar. Rate of return is 10%. In this case, the present value will be equal to $1,000 into 1 divided by 1 plus 1 divided by 10%. But this time discount factor n minus 1. Now in this case, from which year the annuity is started? From which year the perpetuity started? From which year perpetuity is started? Year 3. So it will be multiplied by 1 plus 10% raised to power minus 2. So the present value will be equal to So if we solve it, it will be 8260 will be the present value in this case. Another example, Ali will receive falling cash flows $100, $90 and $110. From year 4, he will receive $110 per annum, but with the growth of 2%. For his entire life. For his entire life, and let's assume the rate of return is 10%. So again, we have to determine the present value. Now, in this case, we have basically the perpetuity and that perpetuity with growth. This concept is used or will be used in this example. And this is the method to calculate the present value if we have a growth in perpetuity. So for example, first of all, year 1, 2 and 3, 100, 90 and 110. And we have the rate of return 10%, so it will be 0.909, it will be 0.86 simple discount factors, and it will be 0.751. So the present value will be 91 for year 1. And what will be for year 2 and year 3? And for year 3, 83. Now from year 4 onwards, we will get 110 but with the growth. And the growth factor will be, growth perpetuity factor with growth will be 1 plus G, and the growth is 2% divided by R, which is 10% minus growth, which is 2%. And this perpetuity started from which year? From which year the annuity is being started? Year 4. So discount factor 4 minus 1 will be the discount factor of the third year, 0.751. So what will be the answer? 1.02 divided by 0.08 into 0.751. No, recalculate it. 1.02, 1 plus 2% divided by 0.08, 10 minus 2% into 0.751, 9.58. So 9.58 is the factor. So into 110, 1053 will be the present value. Okay, you get this? So what will be the total present value? 91 plus 74 plus 83 plus 1053. Okay. So these were the methods. These were the methods to determine the time value for money. We discuss it in very detail. But these are just the concepts. Just remember, these are just the concepts. These concepts will be used uh, in some areas of the financial management. Don't expect that you will be given an entire question of 20 marks from here. These are just concepts. These concepts will be tested in OT question, or they will part a part of a bigger question. So we have discount factor, annuity, and perpetuity. Now we go back to the real thing which we were discussing, that is the investment appraisal. And in the last class, we discussed the accounting based investment appraisal technique, accounting rate of return, and we discussed a simple payback technique, which was a cash flow based, but that was not based on the time value for money. So now we are moving towards the technique which are cash flow based, and as well as these are the techniques which consider the time value for money as well. And those techniques are discounted payback, internal rate of returns, and NPVs, investment appraisals. So let's discuss today discounted payback. Now, the payback period is the time period which is taken to recover our initial investment. That is the payback period we discussed in the last class. So now let's assume if we have the falling cash flows. For example, in year zero, we have invested $100,000, and then we have year one, year two, year three, year four, year five, and onwards. In year one, we have $60,000. In year two, we have $40,000. In year three, we have 35,000. In year four, we have $20,000. In year five, we have $10,000, so on. And we need to determine the payback period. But this time, the rate of return is also given, which is 10%. So we will determine the discounted payback. Here we will determine the discounted payback. It is similar to simple payback, but only one difference, that in a discounted payback, we will consider the time value for money. So in this case, here cash flows, discount factor, present values, and then the remaining investment. So in year zero, we have invested $100,000. Discount factor is 10%. So year zero discount factor will be 1. So the present value will be $100,000, and it is the remaining investment need to recover. Year one, we have $60,000, and the discount factor will be 0.909. So what will be the present value? $60,000 into 0.909. It will be 54,540. So the remaining investment is 45,460. Still need to be recovered. In year two, we have 40,000, and the discount factor will be 0.826. So the remaining investment will be 12,420. And year 3, we have 35,000 into 0.751. That will be 26,285 minus 12,420. Okay, so that means we have recovered the investment in the third year. So what we will do, 12,420 divided by 26,285 multiplied by 12. So 12,420 divided by 26,285 into 12. So we have 5.6 months or 5.7 months. So the payback is 2 years and 5.6 months. This is the payback. And if this payback is less than the target set by the management, then obviously the project will be accepted. We will accept the project. You got it? Any question? So in a discounted payback, now we can say that one of the disadvantage of the simple payback period is removed, and that was that the payback period does not consider time value for money. And in a discounted payback, we consider the time value for money. And the remaining disadvantages will be similar, but the one disadvantage that the simple payback does not consider the time value for money has been overcome by the discounted payback, because in a discounted payback we consider the time value for money in a project, but the whole life of the project is not considered here, because we consider only those cash flows till the point of the payback period. What will happen after payback period we didn't consider either, even in a discounted payback period. Okay, you get it? The next method for investor appraisal method technique is net present value. In a net present value, if we discuss this concept in a simple way, in a simple way, net present value mean that we will take the present value of cash inflows and we will deduct the present value of cash outflows. And if the cash inflows are greater than outflows, we will have a NPV, net present value. And the decision rule is that if the net present value is positive, that means the present value of cash inflows are greater than present value of cash outflows, then the project must be accepted. Must be accepted, because that means it will maximize the shareholder wealth. That is the basic concept of NPV. But obviously, it is not a simple calculation as I'm telling you. Obviously, there is a complete format, a number of adjustment in that format which we have to perform, a number of consideration which we need to consider before the calculation of the NPV. But this is the basic concept, that what does the meaning of NPV? What does the meaning of NPV? Obviously, we will discuss the format and we will discuss the practice question as well. But if I discuss, before I discuss the format, if I discuss the advantages of the net present value, advantages of the net present value. The advantages of the net present value is that net present value is a cash flow based method. Number one, this is the advantage. Number two, it consider the time value for money. Time value for money is considered here. Number three, it consider the size of investment. NPV considers the size of the investment. That is another advantage. ROI payback does not consider the size of the investment, but NPV consider the size of the investment. Number four, it consider the whole life of project. These are the main advantages of NPV. Cash flow based, it consider time value for money, it consider the size of the investment, it consider the life of the project. So NPV has numerous or number of advantages over the other techniques. That's why NPV, as per our syllabus, NPV is the best method. If I would say at the level of FM or at the level of F9, NPV is the best method to take decisions that whether we should do investment or not to do the investment. NPV is the best technique because of these advantages. It is a cash flow based, it considers the time value for money, it considers the size of the investment, it considers the whole life of the project. Because of these advantages, NPV is the best method to be used in investment appraisal decision making. Okay, yes, it has the disadvantages as well. And if we talk about the disadvantages, I would say only one. And the disadvantage is that it is a forecast. NPV is a forecast. It is a forecast. It is estimated value. Okay, and it is budgeted, it is planned, and actual result obviously will be different. So it is a forecast, it is estimated. We take number of estimates, we take number of assumption in NPV. That is a disadvantage, but following are the advantages. And every investment appraisal take, whenever we take the decision, they are all based on forecast, they are all based based on budgeted, whether that is payback, whether that they are all forecast based or estimated based. We don't have in other techniques. That's why I'm saying the NPV. Okay, students, you get it? Okay, students, that is enough. We will continue the net present value from the next class. Goodbye and take care. See you next week. Goodbye. Take care. Goodbye.